All right. And then it says share. And I'm going to go to slideshow. Okay. Well, good morning, everyone. Thank you for joining. I guess we have about 20 people, several Wall Street people, not only speakers, but attendees. We have Rich Gula, who's been on here many times. He is famous for having set up the Fidelity chart room, and to this day consults for about six Fidelity money managers running a couple million or billion, I don't know, a lot of money, and often has worked with Dean LeBaron and knows where and sees where a lot of money goes, and always has some interesting observations when looking at charts. We have Tony Low-Beer, who should be on. Actually, I haven't seen him yet, but Tony, are you here? I'm not going to worry about him. Um, I don't see Chang Qiu either. We have Charles Zhang. Charles, double 800s, Columbia, started working for me as an intern about 2006 and showed a great talent for computers, worked for a couple quant shops and still runs quantitative money to this day. Mitch Bulajic, um, quantitative strategist at ITG. He was an advisor to a hedge fund I had in 2000 um, called Helsinki Advisors, and he's worked for Everest and Elliott, and spent recently last few years in artificial intelligence for a company called Elastic Cloud based out of London, and that brings a lot of insight. But I'm just going to quickly go through my overview. I'm going to try to be quick because we have a bunch of speakers, and I'm going to set an alert for myself so I move quickly. Anyhow, so I'm going to talk about the Great Rotation. And one of my concerns with regard to the market, and I've been wrong, the market keeps going higher and driven by the Mag7, is what's called the Fed model or the risk premium model. And basically, there is very little risk premium. In other words, the market doesn't stocks are not very attractive when compared to the 10-year US Treasury yield. They compare the S&P PE, they invert it, so it's the earnings yield of the S&P 500 and compare it to the 10-year US Treasury. It is close to zero. Now, in 2000, it was -2, and that was a huge sell. And the flip side of it is it was around 6 back at 2008, 2009, during the great financial crisis, during pressures with the in Europe in 2013. It also got up around 7, and that's when everyone was worried about the pigs. And then in 2020, during the COVID collapse, it got up to 6, and I've very successfully used those as buy signals. I've been cautious on this, but the market keeps on going up. But I think that when you compare the S&P to the 10-year US Treasury, you don't want to just look at something and say, well, its PE multiple is very high. I think that comparing it to the most logical comparable being the 10-year US Treasury really tells you on a on an on an asset allocation basis really what is cheap. Um, and basically, stocks are not cheap. And that's what I'm trying to say here. I think one of the problems is we all have what's known as recency bias. And over the last 40 years, people have made a great deal of money, particularly in stocks, bonds, and real estate. And I think over that period, nearly 4 decades since 1981, when interest rates were around almost 16%. They dropped all the way down to 0.5% in 2020 in the summer. That whole period of declining interest rates were, I think, a tailwind to both stocks, bonds, and real estate. And though there was a period where those weren't the ideal asset class to be, and you wanted to be more into commodities after the bubble. For the most part, I think that people really look to those as the place to be, and I think that we hold on a second. Hey, Tony. You're,
Yeah, fucking Google won't let me. It says this app is blocked.
huh? I don't know what to do.
I hate
Um, I can have you speak, and can you? We won't see you, and I'm going to put you on speakerphone. Okay. All right. Well, we got Tony Low-Beer called in, and he's having.
I want to hear what everybody else is saying.
You will, and so I'm adding people. I'm going through my pitch and saying that we've seen declining interest rates, and I think that that opportunity, that tailwind, is gone. I'm going to my next slide, and one of my concerns with regard to the market in general, and I think a lot of people who are particularly Wall Street people realize that the debt to GDP right now is at about 120%, and that hasn't been that high since World War II. And actually, I'm not sure whether I'm seeing this. The interest on that debt, particularly with the bump up in interest rates over the last few years with the inflation resurgence, has put us at a point where debt service is $1 trillion, and that's as much money as we spent on our defense budget. One of my concerns in terms of looking at the market going forward is that we've had a big rise in inflation that's backed off, and it's really become a consensus opinion that, or the Fed has articulated, we should get back down to 2%. But I'm not confident that that truly will happen. Inflation is hard to stop. That certainly was the experience in the 1980s and when I first was getting educated. And I'm showing it. Sorry. That's telling me I'm getting a little long-winded. But U.S. the federal deficit is now $7 trillion. One of the areas for great hope is obviously this idea of DOGE, the Department of Government Efficiency. And I think going forward, the question is, can Elon Musk and Vivek Ramaswamy cut $2 trillion in expenses? My concern is everyone's assuming he can and they can, and it'll work out. And it may not work out. And I think that that's a risk to the market. I think that I've indicated just on a risk premium basis, the market I think is overvalued and arguably very overvalued on a historic basis, though not as extreme as 2000. But you look at the performance of the mega cap stocks, and I got this from Crescat Capital, and this market in its parabolic move in terms of the mega caps really feels like 2000. Paul Tudor Jones once said, parabolic moves never end well. I believe that's the case. We've seen NVDA grow tenfold in 26 months, concomitant with great earnings, but also the advent of ChatGPT. Right. That people basically are suddenly understood what the potential of artificial intelligence, and now that has really affected the Magnificent Seven stocks, because everyone sees this as a pathway to future profitability. I've shown this before, but in 2000, Mitch was working with me at the time as an advisor to this hedge fund. We're up in 5 months, 112% on $12 million, went to 24, 25 million. And 24 million, I guess. So, I've seen these moves where you just get extraordinary upside. And Jesse Livermore once said, I never learned anything in making money. It's only in losing money that I learned anything. And in the subsequent decline, I realized I kept on looking for tech to bail me out. And for the next 8 years, had I gone anywhere but tech, I would have done well. And this chart from Macro Intelligence shows, outperformance in the post 2000 period in emerging markets. And I think that international emerging markets could do well. I think that other sectors, not tech, specifically energy, materials, and mining, should do well. Um, and here's a chart from Ari Wald of OPCO showing that the uh, momentum is starting to shift from cap weighted to equal weighted, and it's slow, and but I think that we can see that do well. One area that I think could do very well is gold. Um, and here's a chart of the GLD, which is the gold ETF, versus the GDX and GDXJ. And what that is showing is that we often get big moves in the gold stocks, and they often trail the price of gold. And I think right now gold is had a big run, but the gold stocks are going to play catch up. And when it does, if passes precedent, you could get an overshoot on the upside. So though gold and gold stocks haven't worked during this post election month or so, I do think that gold could do well, and the miners in particular. One thing I'm doing for my clients is idiosyncratically, which is kind of a one-off analysis. I think that there are a lot of high-yield vehicles that people can put their money in, and I think that that's safe or is safe or could be part of a safe portfolio that provides significant yield. And I list a bunch of closed-end funds, and they're listed here, but yields of 11 and 12% in closed-end equity funds, the GAMCO Global Gold, the Natural Resource Funds, the India Fund, Aberdeen Healthcare, as well as Neuberger Berman High Yield Strategy and the Templeton Emerging Market Income Funds. These are all good managers, good spaces. I think make a lot of sense. And there's a good looking picture of this guy. I'm going to go. I'm going to go to Rich Gula, but because we got Tony Low-Beer on and we're having some technical difficulties, Tony, what are you seeing in the market and what do you think? And Tony, by the way, has a long history. He's one of the guys from the Brimberg lunch crew of a lot of top New York money managers, but he worked over at Neuberger Berman, and I believe he was a mining analyst as well as a portfolio manager. But he was somebody who was very keen on China before China started getting strong in September, and before that, about a year and a half before that, he was keen on Argentina. Kind of sees himself as a deep value economist by training. So, Tony, what are you liking in the market today?
Look, I think this is the Jonestown market, and what I mean by that is that since Trump was elected, there's been a tremendous amount of cheerleading and people believing that Trump can fix things, and I don't think he can. Or let's put it this way, it's not going to be nearly as easy as he thinks it is. I mean, we're running a huge deficit. I don't. I mean, I think the difference between firing people in the government realm and so as a private individual is very different. And I don't think that when push comes to shove and you come up against congressional imperatives, etc., I don't think it's going to be that easy to cut expenses. So I don't think interest rates on the long term are going to go down. With this deficit, I don't see how they can go down unless the economy really collapses. So, I think the U.S. market is incredibly expensive. I really like China because I think the market is very cheap. And, Trump is a really interesting guy in the sense that he really seems to get along a lot better with dictators than he does freely elected individuals. And he's got a long-term history of a love fest with Putin. And I think this thing of his inviting Xi to his inauguration, I think is pretty interesting. And I don't know how it really is going to work out, but I think that Trump is going to seriously antagonize our allies, which has already started with Canada and Mexico. And he's probably going to do a lot better than people think with the dictators of the world. So I really like China. I like precious metals. I think we're going to have peace in Ukraine. And when that happens, I think energy prices are going to drop sharply, which would be a buying opportunity in energy. And I like solar. And the reason I like solar is because we have an energy shortage. And just like no one would touch natural gas, which has now become a favorite since Trump got elected, I think solar needs to become a part of the solution. Costs are going down in solar. It's a very cyclical business that historically, if you look at it, you've had to buy it when the industry is getting killed, which it is now, and sell it when it's making tons of money and everybody thinks it's a solution. I really like no green energy because it's a low cost polysilicon producer in China. It has a bundle of cash, no debt. The stock sells at 18, and 2.5 years ago it was earning at the rate of $20 a share, and the stock traded up to 122. So
that symbol DQ.
DQ, Dog Queen.
Dairy Queen. Okay.
So
you've been a fan of BYD, and we're hearing a lot about electric. What's your thoughts there? Or do you like other Chinese stocks?
Look, BYD has done much better than the Chinese market. And long term, I think this stock is a huge winner because they're innovating in the automobile industry like nobody else. And they have, as I said, they've produced an electric car in China that they sell for $9,500 and with 180-mile range and apparently good quality. And they produced another vehicle that'll do 1,300 miles on a tank of gas. This second vehicle's a hybrid. And I mean, nobody else has come close to that. Now, the one thing that concerns me a little bit about BYD in the short term is the fact that the company has asked for cost cuts from its suppliers, which to me means it probably is experiencing margin pressure, which wouldn't surprise me, which also could mean that a bad quarter. So I think there's more short-term risk in BYD than there is in either DQ or Baidu, which is another one that I own. But I still own it. I still like it. I prefer to buy it on weakness. But I just think we've got a very tough time ahead of us.
What do you like in minerals? Gold, silver?
Well, the thing, I like gold, I like silver. I'm beginning to warm up to copper because I think China is turning. The one thing I worry about the mining stocks is the big problem with the mining stocks is the two biggest companies, which are Newmont and Barrick, are both total pieces of shit. And they've done nothing but destroy shareholder value for years. And that's going to hurt the whole group. I own Agnico Eagle, which I think is the one really good company. I think what needs to happen, and I don't know why it hasn't happened, in both Newmont and Barrick, I think some raiders need to come in and shake those companies up and restructure them. Because to me, they look like prime restructuring candidates. I think they're both worth a lot more dead than alive. One thing that I also like Silver Corp Metals, which I bought at a higher price. They announced a convert. I don't know why. Not sure why, because they have $200 million in cash. But they did announce a convert, which knocked the stock down another 25%. And their main operations are in China. The thing trades like a hybrid between a silver stock and a Chinese stock. I'm very bullish on China, as I've said, and I think Silver Corp Metals was a great candidate for tax selling for the recovery. So that's me.
Tony, thank you very much. I got about 4 other speakers, so we're going to move on, and please stick around. Maybe there'll be some questions.
Thank you. I might have some questions, but right now that's great.
All right. Our next speaker is going to be Rich Gula. And as I mentioned previously, he set up the Fidelity chart room. And so, Rich, I'm looking here at a chart of something that says extend. So I'm not sure whether I did a poor job copying it over, but what is that? And what is
I
that
can't,
that chart?
I'm not seeing my charts. I see everybody's pictures. What do I do to get over? Uh, it's probably my fault. Oh, here we go. Here we go. Um,
Okay, speak
so
up a
yeah,
little.
extend for the first and foremost, the you probably are aware that the healthcare stocks are in the news a lot, and uh, and also there's a variety of emerging market activity that gets expressed through the ETFs that are all in parallel with what in the U.S. That just as a precursor, the extend here is the S&P is a purely extended chart. Doesn't mean that it's um, negative or that you've got a 20% downside in here or anything like that. But there are problems outside that can impact our market pretty quickly. So just keep in mind four healthcare stocks: Moderna, mRNA, uh, Cigna, CI, CVS, same symbol, and UH for United Health. That whole pool, and Moderna is more symbolic of the drug stocks, are all in very serious downtrends, with UH being the one that's just been dented with all the events. Um, the Argentina ETF, which Tony had mentioned quite a while ago, I hope he still owns it because it's outperforming pretty much everything. Uh, but Peru is acting pretty well as well. Poland's in a little bit of trouble, and Korea's in a lot of trouble, and Japan is toppy. And I would watch all five of those regularly because if anything changes for the negative, there's something happening thematically in the global markets that might be of some concern. But okay, first chart. The S&P simply extended. Everybody knows how strong it's been. Most of the publicity is toward the Mag7, but the RSP, which I don't include in this package, I think if you do the equal weighted S&P, it's outperforming the cap weighted generally, but maybe not for the last month or so. Next slide. The ECB today cut
Right, that
rates.
shows rates.
That's right. It's the euro, and the euro is not responding very much to anything in the rate cutting world. The statement from Christine Lagarde was that the disinflationary process is well underway, and I think what she's really saying is there's deflationary process in Europe that is problematic that they don't quite know what to do with. But for now, Europe is not a good place to be in terms of the overall environment. Next slide is which has a label of weak.
It is labeled weak.
That's the
FGBL.
German Bund future, which has got a pattern that's pretty close to the euro. But you would think that that would be improving if, in fact, inflation was going down and you were cutting rates. But there's no appetite globally to be in that particular asset class right now. Next, the China Internet, KWEB. Most of the Chinese stocks, this is actually one of the best. It's got a pretty good base long term. And this does not indicate yet that there's been dollar flows to begin to drive Chinese stocks much higher. I circled the cluster of volume on the far right there, and that is indicating that under that announcement that got everybody interested a while back, there was a surge of interest, but it didn't really move the stocks very much. Next is the China Bull ETF. If I were going to be playing China, Tony's got a good stock in Boyd or in BYD. I call it Boyd. Baidu is yet to respond. It's an old favorite, but I'd certainly just have an exposure here in the ETF that is leveraged for China as a total index.
What is that? YINN?
YINN. This is a bull, and there's I think yin and on the yang. I'm not sure what the other one is. There's one that's also negative that shorts the market.
So it's leveraged.
That's leveraged.
Okay.
All right. The next is a slide which says extend is our good friend Bitcoin, but that's a Bitcoin future. I do think that there's momentum here that's not going to go away. There are other charts. There are Micro Strategy, which is a stock hinged to this. I say hinged because of I heard I'll show you the chart later on. That's parabolic, and I'm a little bit negative on that, but I'm not negative on Bitcoin or Ethereum. As the two major cryptos, I would be careful in the wallet world just because you don't know what you're dealing with in a regulatory sense. Next is the NASDAQ, which is also extended. The NASDAQ made the future made a high at 3:20 in the afternoon yesterday, or 3:40, 3:30. Traded sideways and then sold off sharply. There's a chance that's the high in the NASDAQ for quite a while, but that's not a market call. It's just that I don't like when futures act that way. That high was probably a short cover, and as soon as the shorts recovered, there was nobody left to buy. So we'll keep a close eye on that. Notice I've circled the volume on the far right. Declining volume in the entire NASDAQ index area, not the individual items like Tesla, is we'll just label it as problematic. Next slide. You may have picked up on this. In the old days, it would have been a big deal on the front of the Wall Street Journal, and now it may have gotten lost. But the Dow replaced Intel and Dow Chemical on the 11th of November with NVIDIA and Sherwin-Williams. And so this is a leverage version of that of the Dow Industrials, and you can see that it got a little boost from that inclusion, and that is not looking to me like it's in a perfect uptrend anymore. It's an early stage. I wouldn't call it a fake all-time high, but let's say it's been a manufactured all-time high. Next.
China large cap.
China large cap ETF, FXI. That's the better place in terms of volume and liquidity to be trading China, in my opinion. So I'd barbell that with a couple of stock selections if that were your inclination. I would rather own Argentina than China right now, but that's just personal preference. Next is NVIDIA, everybody's favorite stock. That got added into the Dow on the 11th. That's where that line shows. And I see a lot of careful selling into NVIDIA. It probably is going to lead to staying within the bands that you see there, which is just a simple Keltner channel. It's just standard deviation bands around the mean. And it's a weekly chart that would suggest that their downside would be about 120 if you stayed within the bands, which is the red line on the bottom. But that is all the positive publicity and pumping, if you will, of the stock has not led to any kind of a move. One of the regular contributors to the noontime report on CNBC has been promoting on Facebook a target of 165, and I think that is probably a reach. Next, these are the sort of stocks that have gotten a lot of attention. I can't show you the chart. I've got a picture on my phone.
This is Hood. This is Robinhood.
This is Robinhood. Yeah, this is now a competitor to Schwab and Fidelity. They're going to offer futures. I think that got some pretty good financing behind it, and the chart looks a tiny bit parabolic to me, let's say. But that the dollar flows in the last month were just short of $150 billion, according to reports and charts I see regularly from ETF commentators. Usually LinkedIn is a pretty good source. And so with all that money pouring in, it's gone here and it has not gone to NVIDIA. Next chart is Sherwin-Williams. This is the other addition to the Dow. And I put a line in when it was included. Looks to me like that if you're going to see a microcosm of part of the economy that's pretty strong, this is a pretty good place. Not very exciting. Next chart is the Bitcoin Be Careful stock, MicroStrategies. Someone else can try to explain what MicroStrategies does, but it finds a way to, I believe, borrow money through legitimate bond offerings of some kind, or debt offerings, and buys Bitcoin. That sounds a little tricky to me down the road, but we'll see.
What they do is they buy Bitcoin. They've issued stock. They've issued converts, and some of these are non-recourse. And with that, they've bought Bitcoin, which has gone up, creating sort of a feedback loop. And people are very negative on the stock because they say it trades at 3 times the value of the Bitcoin asset value. But I've listened to Michael Saylor, the CEO, and he says, look, I can issue bonds and turn around and buy more Bitcoin. And I think I'm never going to sell it. This is a new treasury item. Corporations are adding it to Bitcoin to their balance sheets. There is some argument that it'll be added to the balance sheets of central banks, and it should be held just like gold. And if that happens, then I think that the upside is huge. Some people just don't like it because of the premium. But I think of it, having worked on an option floor, they're doing a synthetic, and they're the most liquid option, from what Michael Saylor says, is actually the MicroStrategies options. So they're basically, issuing converts, effectively selling overvalued options and continuing to buy the asset. And the asset keeps on going up. And God knows if Trump and the central banks decide to make this a legitimate asset on central bank balance sheets relative to gold, this valuation is minuscule of Bitcoin versus gold. So you might have 100x upside. But I spoke to another portfolio manager yesterday who said he has a nephew who works over at NVDA who assures them that they can hack it, which I guess the logical conclusion would be, if you can hack it, Bitcoin is not safe. And that could be the sort of thing that could be devastating to the market. So I'm sorry. Now we have inflation.
Wait, I'd like to make a
Go ahead.
comment on Bitcoin, and that is, I think you have a real long-term concern with this, because if Bitcoin turns out to be a currency, then how are you going to finance the deficit? And that's worldwide. So I think that, and this is very long term. I have no position in this, but I think if you look at this really long term, and you're making the case for a currency that's not influenced by governments, that is inherently attractive to the buyer. But I question how long the governments are going to accept this. So that's just my long-term concern.
Okay.
Well, just 2 thoughts. You see the volume spike in the MicroStrategy chart. And so there's a bunch of people out there that are short between 600 and 800, and they're pretty happy right now. So that volume spike suggests that somebody got out of there, and or if they got in, they're underwater to some degree. And the subsequent trading over the next couple of weeks, despite all the framing of the positives here, from the management. This is not a that's not a happy chart. Let's put it that way. Next, CL inflation. There's no inflation in the oil chart, just sideways. And it's interesting that it has not responded very much to quite a bit of international turmoil. So I'm guessing that there's a wait and see here in the global markets about the Trump administration and what the impact's going to be on our whatever our new energy policy will be. We mentioned gold before. This is the COMEX gold continuous contract. Gold has gotten a little bit of selling pressure in it. I think that's pretty normal given how much it's gone up. It still looks like a core holding for those that want to. I think it's more of a hedge on global chaos than it is on inflation myself. But that's just the chart's the chart, and you'd like to buy weakness in this rather than the top of that trading range. And now a few stocks that are symbolic to what's going on in the market. Kava was a popular New York City IPO that a lot of folks made quite a bit of money on, and that looks like it's over to me. So that could be the liquidity and the mechanics of the market rather than anything to do with their business. But
what does Kava do?
It's a popular. I can't remember the theme of cafes mainly in New York City, I believe. There's nothing like it in Boston.
It's like a Chipotle, but it's on European like healthy cuisines.
Yeah, that's right. So there's part of your consumer. If you match this up with Starbucks, I don't know what the pricing is like at Kava, but Starbucks is pricing things right at the edge of people not buying the expensive drinks anymore. And so they've got a struggle on their hands in terms of how to get their earnings back on track. But next is Oracle, which reported earnings today, which didn't go over very well. But this is a classic core tech for more old-fashioned funds. That's a real wait and see. If you want to believe that tech is going to be okay, X the AI speculation, as I would call it, and speculation being that people can fantasize all sorts of things on AI and double any stock that's involved, but most of the stocks have run into some resistance these days or lack of buying. And but a core tech company is okay, but a little bit worrisome in the way that outside bar. That's not a good pattern in the world of candlestick charts. And Nike next. There's been a recession out there in the global markets for several years now that has not shown up in aggregate data. But anybody in the ESOP at Nike will tell you that it's not exactly been fun. And there are small, of all people, this is Kevin O'Leary's money management firm, which he does not run. He did set it up. And lo and behold, this is probably one of the best structured funds I've seen. I urge you to go and look at its top 25 holdings. But it has achieved pretty good performance and a much better chart than most funds. And it's not very liquid, but if you've got somebody that you're playing golf with that wants a stock and they're being a pain, just give them OUSA. So there we go. Donald Trump, I don't like things like the picture that I took a snapshot of the opening in the market today with President-elect Trump with assorted luminaries next to him. And moments away, Trump to ring NYSE opening bell, NASDAQ made a new high, and lo and behold, I'm not sure that the being person of the year is the best omen from the old time contrarian world that I came from, Dean LeBaron. So away we go.
Well, Robert Shiller is somebody that I always found brilliant in terms of explaining the market and behavioral economics. And he talked about 2000 and 1900 being years where they're the beginning of a new century, and there was a sense of a new optimism. And I sensed somewhere between Doge and Bitcoin and Trump, you have the sense that all these great things are going to happen, that wars are going to end, inflation's going to end. And I'm just skeptical, and particularly given high valuations. But enough about what I think. I think what we'll do is Chang Qiu is somebody who I found and have known for nearly 20 years, and he uh, recommended in a period that I think we may revisit. That was the post-bubble period of 2000, around 2003. He was writing on First Call when everybody, all the brokerages were downgrading and dropping coverage or going to sells on all the Chinese internet stocks. He was recommending four names: Sina, Sohu, NetEase, and maybe it was Baidu. And they were all trading at cash value. They were losing a little money, but promised to earn some money. I met with them. I bought them. And unfortunately, I sold them because all those stocks subsequently went up 100 times. And he has quite a bit to say on the China market and stocks that he likes. Chang, tell us what's going on.
Yes. Hi, everyone. Yeah, I think Rich showed some charts earlier. I think I just maybe continue based on those charts. Basically, back in September, when the China stimulus was kind of first revealed, market is quite or was quite excited. So the stock, the internet, the FX side, they all up. But then in the last basically 2.5 months, most of them gave up most of the or all the games. Just a few of them had some of the game kept around. This Monday again, the central government, they kind of discussing more stimulus for the next year. Again, Monday had one excitement, just one day up and then going down. So basically right now, there are a lot of worries. One is whether the stimulus is enough, and like 7 trillion renminbi or something around that one, that amount. Kind of the worries may not be enough. Another thing, the big worry is obviously is the Trump tariff. That's like in everybody's mind. China right now looks like a import export. That's one of the kind of like error that's had some life so far, because the domestic consumption, the investment, the other sectors of the economy looks like a kind of weak. And if the tariffs really come, and then even the export sector will also under pressure. So that's the other big worry. On the other hand, like I think Tony mentioned earlier too, Trump is kind of like President-elect Trump is like a businessman. So he may have some approach. For example, he invited Xi to the inauguration. That gives people some hope. Maybe, maybe he don't want to sink, the both, U.S. or China economy with the so like 40 or 60% of kind of a tariff. So that's remained to be seen. So, but I think my sense is the worry is clearly there in everybody's mind. That's basically suppressed the whole China names. If we see we got some relief there, the stock, I think it can go. encouraging me if I really examine the China internet names, now it's early December. That's like 3 months after the last September run. Looks like it's stabilized here. Hopefully, maybe enough of the tariff worry or foreign exchange worry. Hopefully, maybe enough of them are priced in. For example, Weibo, that's the ticker is WB. That's basically China's Twitter. Looks like that one actually preserved most of the games since September. So, that's a name is more geared towards the domestic economy. So maybe foreign exchange will negatively impact their stock performance. But it is valued at like 5 times earning anyway. So maybe that's kind of the people kind of saying, if the renminbi depreciate another 10% or something, so what? The PE becomes 6 times. So that's still inexpensive. And the other name I recommended before is a PDD. That's like a Chinese e-commerce player. And that one basically, most of the games since September was gone. And even though they reported back in November, they beat both the earnings estimate, the sales estimate, but there are still a lot of worry about the tariff, their program of supporting so-called excellent merchants, and so people still worried about there are maybe going forward we will see like margin compression, sales growth slowdown. So that one looks like again a lot of worries there. It's like 10 times PE. Inexpensive relative to the growth so far. We can see still like over 20-some%. So maybe they drop down to 10% growth. That still matches their 10 times the PE ratio. Anyway, that's what I see so far. I guess maybe now it's a good entry point, because last time early October, that's like quick jump up. Now basically gave up all of those games. That's like a local button. Looks like a local button.
Thank you, Chang. We're gonna have Charles Zhang speak, and Charles, what do you have to say?
Yeah, sure. Hi, everyone. I will give update on our post-earning announcement drift quantitative strategy. Oh, actually, I want to share my screen.
Go ahead. Hold on. I'll make it available. There you go.
Just 1 second.
Randy Hughes typed in something that I thought was interesting. He said that Microsoft elected not to use Bitcoin as an asset on Microsoft's balance sheet. So I think people were hoping if Microsoft went that way, that might be indicative of a positive trend. So go ahead. We see your share here.
Okay. So I will provide an update on our post-earning announcement drift quantitative strategy, including like what kind of stock we have been investing in and how it applies to Chinese ADRs. The strategy had a fantastic November, driven both by strong market performance and also very strong stock selection outperformance. The strategy has had like no Chinese ADR exposure ever since protective profit-taking rule was triggered in late October. So just to provide a refresher on how our strategy works, let's go to this slide. So here are the simplified entry conditions. The first condition is that the stock needs to demonstrate a strong initial price momentum. That's this part. The second condition is that it needs to consolidate for several weeks to several days. This is actually very important because in theory, this process allows large and informed market participants to accumulate like a large position. Their participation are important to both the strengths and the durability of potential future trends. The last condition is that there needs to be a significant company-specific or industry-changing news causing the stock to leave the consolidation range. So ever since the late October highs, most Chinese ADR have lost their price momentum. So once the price momentum is lost, our strategy requires the stocks to go through like all the three conditions I talked about before in order to qualify as a buy again. On this slide, as you can see, KWEB is the largest Chinese ADR ETF. It experienced large outflow after the large fiscal stimulus failed to materialize, and the ETF price momentum turned negative in late October. So there isn't all that much to do with Chinese ADR based on our quantitative system at the moment. The stock picked by our strategy in November has been pretty much all US stocks. My market exposure peaked around 80% invested. So after several weeks of strong performance, we're seeing signs of stalling and loss of price momentum. Therefore, I have been either selling into parabolic strengths or have my protective trailing stop occurred. So my market exposure right now is reduced to like 30% now. So it's much lower compared to 2 weeks ago.
So you said you had a great November. What were you up, 10%?
I'm actually up like 30%, but I'm not expecting this to occur maybe like once every 2 years. It's a very abnormal November.
And your returns, just generally speaking, you think are what, around 30% with this?
Yes, 30% for the entire year. So having like 30% for 1 month, that's very abnormal.
But it seems like you need two events. One, you get a big move, and then you get a consolidation, but then you need a second event, and that's when you buy?
Yes, exactly. I will go into specific examples.
Okay, go on.
So one of my best pick is a TSLA.
What's that?
Tesla.
I'm kidding. Sorry.
So as you can see, you had like very strong price momentum prior to the election. So after several days of consolidation, it broke out once Trump was elected. As you know, like Elon Musk is one of the Trump's largest supporter and donor. So his company are expected to benefit from his outsized influence. Currently, the Tesla is still in the portfolio. It continues to trend very well. Like all the prices are staying well above their moving averages. So there's hasn't been any reason to sell yet.
So you're saying I should have had a Zoom call 3 weeks ago so we could have been riding this signal.
Exactly.
Okay.
Timing issue. It's a timing issue.
Yes. Go on.
All right, let's go to the next one. Another great pick I had was MicroStrategy. I think two of you guys also talked about before. It's a highly leveraged Bitcoin holding company. Its value derived from its substantial Bitcoin holding. It holds almost 2% of all the coins available. So similar to TSLA, it also has strong positive price momentum going into the election. That's what you can see over here. So after several days of consolidation, it also broke out once Trump was elected.
So basically, you had really strong price performance, or was there an announcement here with the first to trigger Tesla and MicroStrategy?
in order to be considered as an investment candidate, it needs to show a strong price momentum first. That's the first stage. But in order to buy into the stock, it needs to go through consolidation. After that, it needs to have some kind of event. Like, for example, right now, most of my trigger occurred after Trump was elected.
Okay.
So Trump promised to fire the SEC chairperson, who has been like very unfriendly to the crypto industry. So I think that's one of the main reasons why MicroStrategy really broke out after Trump was elected. It is a highly volatile stock. I fully exited the stock after it had like a very parabolic movement. And I think, I'm not sure which day it is. I think it was on like the November 18th or something. It had like a huge outsized reversal day. That's when I sold everything.
Okay.
I will talk about one more example. This one is United Airlines. Once again, it also experienced very strong positive price momentum heading into election. It is a much slower moving stock compared to the two other examples I talked about before. Therefore, it actually consolidated for several weeks. It broke out once Trump was elected. So under the new Trump administration, the FTC chairperson, Lina Khan, is expected to be replaced. She has been very aggressive on antitrust issues. So once she's gone, I think United Airlines expects a much friendlier merger environment in the future, so the industry can consolidate more. I'm still holding the stock. I think that's all I have. I'll pass on to Tyson.
Okay, well, that's great. And last but not least is Mitch Bulajic. Mitch, were you going to share something, or do you just want to speak? Mitch, are you there?
Sorry, unmute.
Okay. Well, now we hear you.
I'm going to talk pictures, but I'll be very brief. These are the graphs. These are the pictures that are on my mind lately, so I'm just going to go very quickly over them. Let me share my screen.
What is that, a cardinal?
Yeah, cardinal. Do you see my screen? Should I make it bigger?
Yes, it says great reversion.
Yeah, this is what you were mentioning, Tyson, and this is an interesting chart because it's looking the real economy versus the tech economy reversion, and basically, so it's just suggesting that we might be reversing this. Pretty much what you were talking about. I think this chart has been very accurate in its reversal, so looking pretty good in 2025. This is Bank of America source I found. I'm going to move to the VIX, to the volatility index. I've been watching it closely because since Trump got elected end of the year and a lot of things going on, it's been fairly unusual for the VIX to be low. One thing that I'm finding interesting that the NASDAQ volatility is kind of picking up and leading, although people mostly look at the VIX based on the S&P, which is very low. So that's a good indication that volatility might have hit the floor. That's going to be interesting. How's that going to work with the Santa Claus rally everyone is still talking about? But, you know, that's, again, a totally silly concept. And also interesting about the VIX is that basically a lot of this ETFs and retail funds, generally, they actually tackle on very much once the markets start getting chaotic. You know, these are some assumptions that they're going to be coming in really big on VIX. That's an assumption, which is a big problem for the dealers because the dealers are getting very short VIX. So basically, there's a lot of things brewing up as a perfect storm.
Can you go back? I didn't understand that. On the preceding chart, what is that showing us? And what are you saying?
That shows the positive flow. the positive flow moving into the VIX index from a lot of the
So
different
people are
funds.
buying the VIX because it came down because they're expecting a
Yeah.
spike in volatility because volatility has
Yeah.
dropped, which is usually
Yeah,
a
exactly.
precursor
This
to
is actually, yeah, this is actually more important because watching the dealers, these dealers are related a lot to the speculation on the VIX and keeping it artificially low, but they've been getting very short, so squeeze here could be significant.
What do you
Next
buy?
thing
That's
is,
VXN. I'm sorry. What is
what
this?
was that?
What's the symbol for the VIX ETF or ETN?
No, you have VIX and you have VVIX, which is the NASDAQ, and you have the different ETFs, like you have the BlackRock, I think it's VXX. I think that's the relevant one, the most liquid. Next is natural gas. I've been fairly long natural gas just to make up for my losses last year, constantly thinking that it's going to break out of the range. There's an interesting thing going. There's a lot of factors with natural gas. And Tyson, you know, you've been involved in companies with natural gas. But I think what's revealing here is there's a lot of Trump factors and the whole energy policy they're playing it. But I also think, like, for instance, this is an interesting chart that basically Morgan Stanley came out with interesting because they're actually coming now, all the factors in the game with the natural gas, they're lowering their supply predictions dramatically for 2025 and 2026. As you can see here, how it dropped. I think there's a lot of factors in playing why Morgan Stanley came up with this. And having that in mind and where natural gas is trading on the lows, it makes a perfect sense. I was picking on every drop of natural gas. It really worked for me. I'm actually really piling up now because I think when it breaks this range that has been 2 to 3 years, it's going to be a significant move. And I think this is going to be a move that's going to last a couple of years. Again, I'm not getting into fundamentals. There's a lot of factors going on. I'm just kind of giving a kind of summary of everything that's going on with Morgan Stanley report, that I totally agree with. Gold and copper, I watch this all the time. Gold because it's gold, copper because copper is a pure play on China. So basically I watch copper very often. And I think this whole commodity cycle in China, I'm bullish on both. So, and I think this ratio between gold and copper is going to close, but not on the downside gold, really on the upside copper. So, you know, watch copper, gold, watch China. I'm not there yet therein, but I suspect sometime as 2025 and the commodity cycle confirms inflation, we'll be there. This is one of the anomalies also important to watch, the dollar index and the 10-year gap. Okay, this is not normal. Something's got to break in. Closely watch it.
So actually, I'm not good at that. Can you go back and explain what do you mean by that? So like the yield needs to go up on the 10-year treasury or the Deutschmark needs to decline? Explain that.
No, it's not Deutschmark. This is dollar index.
I'm sorry.
DXY, that's the dollar index. I'm just talking about the gap between the dollar index and the bonds.
So
Okay,
the dollar
next
ought to
one.
weaken.
Well, or the bonds are going to strengthen. We got to see, something's got to give. I mean, it's an interesting gap that always closes on one side or another. Okay, here's my favorite story going into 2025. My personal belief is it's like a total decoupling and bankruptcy of the European Union. I follow Europe. I just came back from Europe. I have a lot of friends and businesses there, and it's an absolute disaster what's going on in Europe, and the denial is something I thought we here in America were in denial, but when I came back from US, from Europe, I felt like it was the roaring 20s, and economically speaking. One thing that baffles me, the ignorance, is if you look at this chart, it's showing the DAX index versus the assessment of current conditions. The gray line is actually the European current conditions, and you see the German current conditions are even worse. The DAX and a lot of European indexes are totally ignoring this. I'm actually very short the euro. I think it's just a matter of time. I think that by New Year we'll see parity in euro and the dollar. And so when that happens, that's pretty much going to be breaking all the indices, especially the DAX. And the reason I like this index a lot is because of the volatility. The DAX option volatility is practically very low. Totally, utterly ridiculous. Okay, this is colossal move. I mean, the point is the options are cheap in an economy that's pretty much going to be bankrupt, not to mention the Ukrainian war and Russia and all the things that are going on. But this is my play for 2025. And then let's talk a little valuation. And interestingly enough, if you look at valuations here, Asian equities are still trading at a large valuation discount to the US, but in line with Europe. Again, another totally ridiculous thing going on. It's like, what does this tell you? Go long Asia and short Europe, or just short Europe and go long anything, the corner barbershop, whatever. It's going to work. And one of the reasons I work in the tech and the AI industry in Europe, and I can tell you this chart is dramatic. I know it's true, but I didn't know it was that bad. What this chart tells you is the market cap, the European tech market cap versus the US market cap. That's one of the downfalls, not the only one of the Europe. Europe has actually missed the whole tech boom, and now they're missing the whole AI boom. A little bit of an exception is UK and London, where I'm right now, and that's the only oasis of AI in Europe. And this is one of the reasons, because Europe is just falling back on anything and everything. And this is one of the reasons. You cannot have growth if you don't have technology. End of the story. That is why pretty much it's just between US and China, so in total command for the next 10 years. That's it. That's on my mind. Thank you very much.
Thanks, Mitch. Okay, we've gone on for an hour and 10 minutes. So are there any questions, or does everyone know what to do? I think we got a lot of great ideas.
You got to go out and trade.
Just add one
ahead,
comment earlier, because we several guests discussed the micro strategy. Once then they get those investors excited is they kind of thinking maybe micro strategy will be included into Nasdaq 100. The announcement maybe tomorrow. So that's kind of like get many people in anticipation.
Wow, where did you hear that?
They said the Nasdaq 100 had basically composition change once every year, and the camera shot is the November 29, and at that date, MicroStrategy is like in the number 52 in the among the 100 largest market cap companies. So they most likely, if only by market cap, they most likely will be included in Nasdaq 100.
Well, that's their methodology. They're market cap related. So yeah, given what the stock's quadrupled or something, so it now has 100 billion market cap now, something like that. So yeah, I guess that's highly probable and predictable.
So basically, that people guessing if they get along, they get included. So by next week, December 20th, they will have much more flow into the name, in terms of passive flow, because QQQ and many other index was tracking Nasdaq 100.
I have a question.
Go ahead, Walter.
Yeah, I mean, Mitch, I think that
Yeah.
I'm very excited about your idea of shorting the euro. Do you already, I mean, I think that seems like a great way to sort of insure almost any portfolio. Have you already done that, or are you just talking about it?
I'm shorting. Yeah, I'm shorting the euro and the futures. I'm not hedging any portfolios. I'm just piling up and shorting.
Right, well, just to make money.
Yeah, just to make
Yeah,
money.
yeah, of course. Well, that's a good hedge for the portfolio. You and Tyson, I know, are, I guess, obviously good friends. That's why you're here. Why don't you discuss with him how to do it? Because it's something that I'd like to do.
Can you say exactly what you want to do? Hedge portfolios?
We'll give you a call, Walter.
Pardon?
We'll give you a call. We'll take this offline.
Yeah, well, I mean, it seems
or Mitch, explain how what you're planning on doing or how you're
no, I understand. It's more just actually what you're doing, how far out you're going, stuff, you know. I mean, it's
okay, I'll tell you it's related. It's two related things. Euro is actually just a reflection of ignorance in the European Union, with the European economy. It's a separate two things. I'm shorting Euro is just purely shorting it for money. Right. But I'm also going to be getting in, and I'm going to be putting the short positions as well on the DAX index. Am I going to be hedging? Not really, because I'm going to be putting option strategies. So by their nature, they're a hedge. So I don't have any portfolios in Europe that I need to hedge. But if you do have exposure in Europe, you've got to hedge. I mean, you know, that's the least you can do, and you can probably do it because it's cheap now and it's desperate. So, you know, if you don't do it, then you got a problem.
Yeah, right. Well, I can't, I'm mostly a domestic portfolio, but it just seems to me with the massive amount of debt that's still out there, that, you know, something wrong could happen. And it would appear, I mean, this just makes me think of when Soros, you know, fought the pound. I mean, that was brilliant. And make a lot of money. I mean, I consider making money.
Actually, that is a similar situation. Actually, that's how I started my trading career in Hong Kong. And that was just about that time when Soros started shorting the British pound. That's pretty much the same thing. It's a disastrous shape of the UK economy with total ignorance, and eventually it had to break. The mechanism with the euro is a little bit different, but I think it's a sure shot. This going down to parity is a sure shot. And I think it's going to go even under. I think Europe is just, you know, it's going to be devastated.
Excellent.
Okay, Walter, we'll give you a call back on that.
Please do. Also, I just mentioned, Mitch, I agree with you on natural gas. Rosenzweig, and I can't remember the other guy, but they've pointed out, as you probably know, if you're this negative on it, that they've done all this stuff on the various. I'm an old man, so I'm having difficulty bringing up the right word, but they think that the production of natural gas here, and we're big, is peaking, among other things. And so I too am short, or I shouldn't say short, I'm long it. I will just say this from my own portfolio. Coal is priced off of natural gas domestically, as I'm sure most people know. And there's one company that's the best coal company in the country, which also has exposure to the other hydrocarbons, and that is Alliance Resource Partners, ARLP. And I just recommend it. It's got a huge dividend, and they know what they're doing. Okay, enough from me.
Thank you, Walter. Mike Portnoy, any thoughts, questions? John DeAngelis? Sid Jane? Last chance.
Just get them off.
Hi. Thank you,
Hi,
Tyson.
Okay. All right. I got John DeAngelis. Go ahead.
No, thank you. I thought it was an excellent presentation.
Thank you.
Some I agree, some I don't agree. Very good.
So Tyson, you were saying something? This is Sid.
I was asking who did so John, did you have a question or should Sid Jane speak?
I have no questions. Thank you.
Sid, any thoughts?
Yeah, I mean, listening to all the speakers, there's definitely a place for alternative investments in any portfolio. for diversification, from paper-based assets to real-world assets. I think real estate can play a very powerful role, especially passive income, and they are tax efficient as well. You usually don't pay any income taxes on the current income due to depreciation and write-offs, and the capital gains can be tax sheltered via 1031 exchanges. So you can swap till you drop. So let's say, for example, you started with a $1 million cost basis 20 years ago, and by the time you pass away, the asset is worth 100 million. So taxes are wiped out on $99 million in capital gains, and also you did not pay any income taxes in the meanwhile, and your family gets the assets at an appreciated basis, just like stocks. So it's a great way to create generational wealth and to pass on your wealth for estate planning. And if the assets are in passive income investments, then the assets keep creating income, the heirs keep getting the income, and they don't really fight amongst themselves, because a lot of times when you have these generational assets and they're passed on to the heirs, for one reason or the other, the heirs can't decide which properties to sell, which to keep, and that causes friction, and the heirs usually end up suing each other, which the parents never really intended. So in a way, it's better for the heirs to have income coming in, and that kind of eliminates all the fights amongst themselves as long as they keep getting the money. So I think it's a very, very powerful way. And some of the other programs are oil and gas, the intangible drilling costs. They can give you up to 90% in write-offs and income taxes and capital gains taxes. So those can be very powerful tools to deal with taxes. The other powerful tool to deal with taxes is opportunity zones. Under the Trump tax cuts in 2017, those were created. And I think in 2025, they will seek to extend those cuts further. So the opportunity zones can also be very useful in deferring capital gains taxes.
Okay, Sid, I got a question for you.
Yes.
Did you get that leather jacket from the Jensen Huang collection?
It seems like it.
Okay.
Actually, my brother is one of the senior vice presidents in NVIDIA, and I was visiting my brother at NVIDIA just for a tour, and then Jensen comes by, and he was leaving for the airport, so we actually got a picture with Jensen, and he was wearing his signature jacket, and I was like, that's really cool. So I went ahead and I bought one of those.
I have an eye for style.
Thank you, sir.
Any other questions, folks, or we'll wrap it up here. And Sid, thanks for sharing on that. Rich?
Yes. Can you hear me?
Yes.
It's not really a question, but I just would like to remind everyone that if you own any of about probably 1,000 stocks, ETFs are pricing them, not your local friend, the portfolio manager that you gave a tip to because you already own it. And if the AI answer to how many ETFs own NVIDIA is over 500, more specifically 487, based on one of the better ETF trackers. And then the generic says 1,248. So if 1,248 and 457 are your boundaries, maybe 700 are liquid. And with $150 billion coming into the market last month and NVIDIA slowing, there's a mismatch here. And for those of you that are sports fans, Tom Brady made a living out of mismatches, not out of strategy. Anyway, happy holidays.
Thank you. And last questions. I think we're done here. Merry Christmas, Happy New Year. Give me a call if somebody said something here that's intriguing, and we can pursue it. Thank you, John DeAngelis, Walter, Sid, Rich Gula, Charles Zhang, Chang Qiu, Neil Winward, Duncan Riefler.
Thank you.
Thank you, Tyson.
Okay, thank you. Thanks,
Thank you.
everyone.
Happy holidays.
Happy
guys.
holidays.
Happy
guys.
holidays.
Happy
Bye.
holidays. Bye,
Merry
everyone.
Christmas.
Bye,
Happy
everyone.
holidays.